Hello traders and welcome back to xm.com. This is the weekly technical outlook video for the week starting Monday, October 16th. I'm Cristina Bartenido, investment analyst, and in this video I'll share my view on gold, pound dollar, and Aussie dollar. While tensions in Israel will keep influencing safe haven assets such as gold, while jobs data and inflation prints could make the British pound to move. Pound dollar could also get affected by the US retail sales and a speech by the Fed chief Jay Powell later this week. And finally, China GDP growth figures is something that nobody should miss, as especially those who are trading antipodium currencies, antipodium pairs such as Aussie dollar. So starting first with gold, gold could face some extra volatility on the back of Israel, on the back of conflicts in Israel. U.S. officials will be in Israel this week with scope to calm tensions and avoid a broad conflict in Middle East. So we see gold consolidating its gains at the moment, slightly below its 200-day moving average, which acted as a resistance on Friday near 1930. From a technical perspective, the risk is still skewed to the upside. We can see that the RSI is still comfortably above its 50 neutral mark. The MACD keeps strengthening above its red signal line, but the stochastic oscillator is already in the overbought zone above 80, and the RSI, if you closely look at the indicator, is near its previous high, so a downside correction cannot be ruled out either. Traders could remain on the sidelines until they see a break above the 200-day moving average, and more importantly, an upside correction above the 1944 region, where the 15% Fibonacci retracement of this downfall is located. If that happens, then the rally could extend up to the 61.8% Fibonacci of 1976, where the precious metal found strong resistance from May to July 2023. Now, in the event the price corrects below this descending line, which has switched into a support area, and closes below the 50-day moving average as well, around the 1900 level, then we may see a negative correction down to the 23.6% Fibonacci of 1873. The price could also test Friday support area around 1867, a break of which could then confirm additional losses, probably towards October's low near the 1800 level. That area was also a key base back in February and March 2023. So failure to hold here could cause another downfall, probably driving the price into the 1773 and 1750 region, where this descending line is located. If the sell-off continues from here, then all the attention will turn to this support line coming from the 2018 low. This is seen around 1725 level at the moment. And now turning to pound dollar and UK data releases, we expect some weaker. We expect jobs growth to remain in the negative territory in August. UK CPI inflation data could also face extra weakness, so that could add some downside pressure on pound dollar if the readings come lower than expected on the jobs report, and if inflation continues to weaken. But there's also the US factor, which could play a big role this week. We have US retail sales and a speech by the Fed chief Jay Powell later this week. If the Fed chief uses a relatively dovish tone, reducing the odds for a rate hike later this week, that could still help pound dollar to switch into recovery mode, especially if it also closes above the 20-day moving average at 1.22. Then we may see the price rising up to the 1.23 25 key constraining zone, where this falling line from May 2021 and this shorter term descending trend line from July's highs are both located. If we overcome that wall, then the pair could extend its recovery up to the 1.2440 region, where the 50 and 200-day moving averages are located, while a break above the 1.25 barrier could bring the 50% Fibonacci retracement of this downfall at 1.2588 next into view. Well, if you look at the technical indicators down here, well, we haven't seen significant improvement in the signals, in the technical signals. So the market still was flattening above its red signal line. The RSI still below its 50 neutral mark, and the stochastic oscillator has changed direction to the downside, heading towards its 20 oversold level. So it seems that the pair hasn't really overcome negative risks, but for the pair to resume its negative momentum, it will probably traders will probably need to see a decisive close below the 1.21 level. This is where this important tentative support trend line from the 2020 low of 1.0324 is located. If the price breaks that floor, it could next head for this constraining line from November 2021 at 1.1980, unless October's low 1.2036 blocks the way down. And if a steeper decline happens below driving the price below 1.1980, then I expect the next stop to be somewhere between 1.19 and 1.1925, where this support line is located. We may see some stabilization here before the price continues towards its 2023 low 1.18. And finally, turning to Aussie dollar, well, China is expected to face a weaker GDP growth in third quarter of 4.4% year on year. But we have seen China showing some recovery over the past 2 quarters, so it will be interesting to see whether China's growth will surprise to the upside, and potentially signaling that the stimulus measures are indeed working in China's economy. So if we get higher than expected GDP prints, that could be good news for Aussie dollar. The pair could break above the 0.6330 resistance territory where it's currently trading, and in this case we may see an extension up to the 23.6% Fibonacci retracement of this downfall at 0.6426, where the 50-day exponential moving average is heading. Then above that, the next obstacle could come around the 38.2% Fibonacci of 0.6515. We saw the price posing here during the previous months. So another successful battle at this area could probably provide could further stimulate the pair, likely driving the price into the 0.6585 and 0.66 region, where the 200 exponential moving average is located. And now in the event, the data meets expectations, that could pressure Aussie dollar below this support line coming from December 2022. That is where the price is creating a floor around near its 10-month low of 0.6284. So failure to hold here could cause another downfall, probably down to 0.62, and then if the sell-off if selling pressure persists, then we may see another negative correction down to 0.6120 and 0.61. So that's all for this week's important markets. Thank you for watching, and see you next time. Bye bye.